Hello, this is Professor Ki Chan at UIC School of Public Health in the Department of Health Policy and Administration. This week, we're going to continue our conversation about financial ratio analysis. Financial ratio analysis is a great way to evaluate the trend within your organization across years, as well as compare your organization finances with another organization within the same industry. This is a recap of the 4 ratios that we discussed about liquidity: current ratios, quick ratios, which are information that's taken from the balance sheet, days cash on hand, and days in account receivables are information that's taken from the balance sheet and the income statement. All 4 of these ratios are crucial to evaluate how much cash your organization have at hand. This week, we're going to focus on activity ratios. Activity ratios are an effective way to evaluate how efficient your organization is using its resources. In the first half, we discussed liquidity, which emphasizes on how much cash at hand, how much liquid your organization have. Now, let's say that there is enough liquid in your organization. You want to analyze whether your organization is using those resources efficiently. The question that you want to ask using the activity ratios are the assets generating sufficient or surplus revenue to pay for the operating financing activity of the organization? The other question you may want to ask is, was the cost of the assets well spent, or did we make budget cuts? We want to focus on the costs and revenues of the assets. The 3 types of activity ratios that we're going to focus on are assets turnover, which is operation revenue divided by net assets. If you remember from the 2 financial statements, operating revenue is from the income statement, and the net assets is from the balance sheet. The other ratio we're going to focus on is inventory turnover. Supplies, cost of goods sold, divided by the average inventory. The other 3rd activity ratio is average payment period. This is the accounts payable, which is extracted from the balance sheet, divided by annual purchases, divided by 365 days. This will give you the average payment period. The next ratio that we're going to focus on are known as debt ratios. This helps you ask the question, how much debt is the organization making to keep up its operation? The debt ratio is known as debt over equity. How much of the organization's debt is paid by its assets? Some of the other common debt ratios are long-term debt to net assets. The other one is net assets to total assets. The last one is time interest earned. From a nonprofit organization, it is the revenue minus expense plus interest expense. That total amount divided by interest expense. These ratios allows you to understand how much asset your organization has that's available to pay out its debt. Now, when the numbers are not very positive, this is an opportunity for you to consider what will be strategies to either increase the assets or decrease the debt, and also explore other revenues to either get more loans or either to get more stakeholders to invest to increase your equity. There's a lot of different strategies that the debt ratio that can help alleviate any pressure in the organization. The next ratio is called the profitability ratios. These ratios help you examine the organization's ability to produce more revenues than expense. These are the ratios that you hope to see to be big and to be positive, and that you see an upward trend in your organization between years. It will be great to see an upward trend between years, but if your organization has the similar ratio across year, also taking into account inflation, that's a relatively okay sign as well. You want to really compare your profitability ratio against other competitors within your same industry. This is the ideal way to see where you stand in an organization. And also taking into account whether the timing of certain types of revenues being generated may be affected because of seasonal issues. For example, if you're at a retail store, you would imagine that profitability ratios would be highly dependent around holidays, around Thanksgiving, Thanksgiving sales, Christmas time, and also around back to school sales. Whereas times during the winter time where individuals may be less likely to go shopping, you will see those ratios declined during those times. So it's important to look at these profitability ratios, but also taking into account the timing of when these ratios were taken and whether your industry is dependent upon seasonal changes, economical changes, or some type of external forces. And as you learned previously, we did a SWOT analysis. And with a SWOT analysis, which you identify the strength, weakness, opportunity, and threats in your organization, you can use these type of elements to help justify why your ratios are the way they are. The three most common profitability ratios are the operating margin. This is the net operating income divided by the net operating revenue. These two elements are taken from the income statement. The other ratio is the net margin. This is the net income divided by the total operating revenue. And the last ratio to identify the profitability in your organization is the return on assets, the ROA. The return on asset is the net income divided by the net assets. The net assets is taken from the balance sheet. Let's recap the three different categories of financial analysis that we can analyze using the balance sheet and the income statement. The first one was liquidity ratio, the second was activity ratios, and the third was profitability ratios. With these three categories of ratios, you can then conduct a comparative analysis. A comparative analysis allows you to evaluate any trends between years and also across industry. You can calculate the percent change between years. Did it increase or decrease? Make sure that when you express any decrease that you show it with a negative number. Was there any warning signs beforehand? You can look at previous year's financial information and see if there was any warning signs. Did the company all of a sudden take up more debt without having increased its assets? Or was there inventory that was left on the shelf longer than expected? There's a lot of information that you could extract from the financial sheets, but it's very important to conduct a ratio analysis because that's the only way to compare between years and across industry. So for example, let's say in the first year in 2010, you had a current ratio of 0.7. And then in 2011, it was 0.8. So what you can do is identify the percent change between those 2 years. 0.7 minus 0.8 is a difference of 0.1. 0.1 divided by 0.7 is around 14%. So you can conclude that there was about a 14% change in a positive direction between the 2 years. Now let's say in 2011 you had the ratio of 0.8 And in 2012, the current ratio was 0.7. Now, you would look at the difference. 0.8 minus 0.7 is 0.1, but this time the denominator is 0.8. So 0.1 divided by 0.8 is about 12.5% negative. So you can conclude here that between the year 2011 to 2012, there was a decrease of 12.5% in the current ratio. These are methods to help you evaluate the meaning behind these ratios. You could also compare these ratios between industries. So if you were given 2 companies or 3 companies, you can compare your ratio between the 2 different companies. So you look at your current ratio of your company compared to the current ratio of company B, and also compare to company C. Look at the percent change. Is yours higher? How much higher? Is it lower? How much lower? And did you notice a trend across? What is it about their organization assets and liability that indicates that their ratios are higher or lower? There's a lot of information that financial data can provide to you about your organization as well as the industry, whether you're in an industry that is in a positive trend or whether it's stale or whether it's a time to get out of this industry. When you work on your business case study, I would highly recommend that you refer back to these questions to guide your analysis. First, calculate the percent change between years or between industry. Do you notice an increase or decrease? Was this expected or unexpected? Was there warning signs as indicated in the financial data? You can also look at the current events that was happening around that time to understand whether these are reasonable ratios. If everyone in the industry was having an economic turmoil, then it's expected that all the ratios would be either lower than previous year or even heading toward a negative trend. That's why it's also important for you to do a lot of research to understand what was going on around that industry during that time. In your analysis, be sure to compare the industry ratio and are you doing better? And why is that? Is this trend sustainable? Was this ratio due to the fact that your organization took up more debt? Is that a sustainable strategy? Are you doing worse than your competitors? Why is that? And how can you improve? Based on looking at their financial statements, is there something that you could learn and implement in your organizations? I find that numbers can tell you a lot of the stories behind the scenes. I hope that you find this information helpful as you learn more about financial analysis as well as working on your case studies. See you on Blackboard.